Money has language, and like any language, if you don't know the key words, you can hear the conversation, but you can't really understand what's being said. Terms like equity, leverage, or cash flow get thrown around all the time in finance, but very few people ever stop to understand what they actually mean. So let's find out. All right, first of all, equity. Now, when people talk about wealth, the word that quietly sits underneath most of it is equity. Now, equity simply means ownership. If you own a piece of something that produces value, that piece is your equity. If you own shares in a company, that's equity. If you own part of a business, that's equity. If you own property after subtracting the mortgage, that remaining value is equity. And at its core, equity answers a simple question. What part of this machine belongs to you? Because wealth is not really about money moving through your hands. It's about owning the systems that generate that money. Think about a simple business, okay? Imagine a small software company making $2 million a year in profit. If you own 50% of that company, then half of that value belongs to you. Not just the profit today, but the value of the entire company. So if investors believe that a company will keep producing those profits for years, they will assign it a valuation. Maybe the company is worth $20 million. Well, if you own 50%, your equity is worth $10 million. You didn't earn that money through a salary. You own a share of the machine. That's the key distinction. Most people operate entirely in the world of income. They exchange time and skill for money. Once that effort stops, the income stops as well. But equity works differently. When a startup grants employees stock options, what it's really giving them is potential equity. If the company grows and becomes valuable, that ownership becomes valuable as well. This is why you sometimes hear stories about early employees at companies like Apple or Google becoming extremely wealthy. Their salaries were not the primary driver there, the equity was. When the company grew, their ownership grew with it. And something to note here is that equity also changes the incentives inside of a system. When someone only receives a salary, their motivation is often stability. When someone owns equity, their motivation shifts toward growth, efficiency, and long-term value. Owners think differently than employees because they're exposed to the upside. But equity doesn't only exist in startups or technology companies. Real estate is another example. If you buy an apartment for $300,000 with a $60,000 down payment and a mortgage covering the rest, your initial equity is $60,000. Over time, as you pay down that loan and the property potentially increases in value, that equity grows. The property becomes a store of ownership. This is why equity is considered one of the most powerful financial concepts. It ties your financial future to the growth of productive systems. When those systems expand, your ownership captures part of that expansion. Next up, leverage. Now, if equity answers the question, what do you own? Leverage answers the question, how much power does your effort have? Leverage is the ability to produce a larger outcome than your personal effort alone would allow. In simple terms, leverage means using other resources to multiply what you can do. Those resources could be money, technology, people, or other systems. When leverage is present, one decision or one unit of effort can influence a much larger result. Without leverage, your input is limited by time. There are only so many hours you could work in a day. With leverage, your output is not strictly tied to your personal labor. That difference is where large-scale wealth often appears. The easiest form of leverage to understand is financial leverage, which is simply borrowing money to control a larger asset. So imagine someone buying a $500,000 property with $100,000 in cash and a $400,000 mortgage. Instead of needing the full purchase price, they used borrowed capital to control the asset. If the property increases in value by 10%, the property is now worth $550,000. The increase in value is $50,000, but the investor only put down $100,000 of their own money. That $50,000 gain represents a 50% return on their actual capital. Leverage amplified the result. This same principle exists throughout finance. Companies use leverage to expand operations. Investors use leverage to control larger portfolios. Governments use leverage through debt to fund infrastructure and programs. Leverage is not inherently good or bad, it is a tool. Used carefully, it accelerates growth. Used recklessly, it magnifies losses. And this is why leverage has played a central role in many major financial events, including the 2008 financial crisis. During that period, many financial institutions had taken on extreme levels of borrowed exposure to real estate assets. When housing prices declined, leverage amplified the losses. The same mechanism that could accelerate wealth can also accelerate collapse. But leverage is not limited to borrowing money. Technology is another powerful form of leverage. A single software developer could write code once and distribute it to millions of users. The same product could be copied and delivered repeatedly with minimal additional cost. This creates enormous scale from relatively small teams. Media leverage works in a similar way. A book, a video, or digital product can reach millions of people without requiring the creator to be present each time it's consumed. And people leverage is another form. When an entrepreneur builds a company with hundreds of employees, each employee contributes effort that expands the company's total output. The founder's personal labor remains limited, but the system they built multiplies that labor. In all of these cases, leverage changes the relationship between effort and outcome. And once you begin to recognize leverage, you start to see it everywhere. A small team controlling global software platforms, a single investment managing billions in capital, a piece of intellectual property generating income for decades. In each case, the output is no longer limited by the individual. The system multiplies their reach. And that is the real importance of leverage. And if you want to go deeper on the real importance of all of the things we're talking about here today on our YouTube channel, we created the ALUX app exactly for people like you. On the inside, we've got daily coaching lessons and expert collections, and the ALUX Network, a curated ecosystem of founders, entrepreneurs, and CEOs that you can network with, compare notes, share ideas and advice with people who get it. You can download the app for free at alux.com/app, but as a gift, scan this QR code afterward and get 25% off your annual premium membership. I'll see you on the inside, but in the meantime, let's carry on. The third key word of wealth that we're talking about is compounding. Now, compounding is the quiet force behind most long-term wealth. And compounding simply means that returns begin to generate their own returns. Instead of starting from the same base every year, that base itself grows. So imagine investing $100 and earning 10% in a year. At the end of that year, you've got $110. If you earn another 10% the following year, the return is not calculated on the original 100. No, it's calculated on 110. The gain becomes $11 instead of $10. That difference seems pretty small at first, but the effect repeats every year, and over long periods it creates accelerating growth. The key insight is that compounding doesn't grow in a straight line. It grows in a curve. The early years feel slow, and they are. The later years move much faster because the base becomes larger and larger. This is why long-term investors often emphasize patience. The biggest gains typically appear after many years of steady accumulation. Now, compounding has been a central feature of modern financial markets for over a century. Broad stock market indexes such as the S&P 500 have historically produced long-term average annual returns in the range of roughly 7 to 10% after adjusting for inflation depending on the period being measured. Now, those returns alone might not look extraordinary, but the real effect appears when they accumulate over decades. For example, a $10,000 investment growing at 8% annually would become roughly $46,000 after 20 years. Extend that time horizon to 30 years, and the same investment grows to over $100,000. The growth in the final decade becomes significantly larger than the growth in the first. Time amplifies the process. Now, compounding also applies in reinvested income. If a company distributes profits as dividends and those dividends are reinvested into additional shares, the investor gradually owns more of the asset. Future dividends are then paid on a larger base of ownership. This feedback loop strengthens the compounding effect. Now, a similar mechanism occurs in real estate. Rental income can be reinvested into additional properties or used to reduce debt on existing ones. As loans shrink and rental income continues, the investor's equity position improves. The same principle applies across different asset classes too. The details might change, but the mechanism remains the same. Reinvestment leads to growth of the base. Growth of the base increases future returns. Now, compounding isn't limited to money either. The concept appears in many areas of life. Skills compound when they are practiced consistently. Knowledge compounds as new ideas are connected to previous ones. Networks compound as relationships grow over time. Small improvements repeated regularly can create large advantages. In finance, however, compounding has one critical requirement: continuity. The process only works when it's allowed to continue uninterrupted. Large losses can break compounding because recovering from losses requires disproportionately large gains. A portfolio that loses 50% of its value must gain 100% just to return to its original level. Preserving capital allows compounding to continue. Another threat to compounding is impatience. Many people interrupt the process by constantly moving between investments, reacting emotionally to short-term market movements, or withdrawing funds before the compounding curve has had time to accelerate. Short time horizons weaken compounding. Long time horizons strengthen it. Because compounding rewards duration. Once you understand that concept, many financial strategies begin to make more sense. Long-term investing, reinvested dividends, and patience during market volatility, all of them are attempts to protect and extend the compounding process. Because while leverage can accelerate growth and equity determines ownership, compounding is the mechanism that turns steady growth into significant wealth over time. All right, next up, we're talking cash flow. Now, cash flow is one of the most practical words in finance because it answers a very simple question. Does this thing produce money regularly? Now, cash flow is the movement of money in and out of a system over time. In personal finance and investing, it usually refers to income generated by an asset after expenses are paid. If an asset consistently produces money that you can withdraw or reinvest, it has positive cash flow. Now, this idea sounds simple, but it changes how people evaluate financial opportunities. Many people focus only on price. They ask whether something will become more valuable later on. But very few people stop and wonder, does this asset generate income while I hold it? Assets that produce cash flow can support themselves. Assets that do not must rely entirely on appreciation. If your living expenses are covered by income generated from assets, your dependence on active labor decreases. The system begins to support itself. This is why many financial independence strategies focus on building a portfolio of income-producing assets. The goal is not only asset value, but reliable income streams. People seem to forget that your assets need to also produce money eventually, unless you plan to wait and sell everything for a big paycheck when you're like 65. You can't really buy dinner with stocks, at least not directly. Stocks, real estate, businesses, most assets become truly useful when they begin converting their value into spendable income. Dividends, rent, interest, royalties, profit distributions. These are the mechanisms that turn abstract wealth into something that you can actually live on. And last, we've got scale. And we left scale for last because people often confuse it with leverage. Now, the two are related, but they describe different things. Leverage is about tools that multiply effort. Scale is about systems that grow efficiently. Now, another way to see it is that leverage helps you do more. Scale helps the system become bigger. You can have leverage without scale. For example, hiring more employees increases output. That's people leverage. The company can take on more work because more people are doing the work. But if costs grow at the same rate as revenue, the business is not really scaling, it is simply becoming larger. Scale appears when output can increase without costs increasing at the same pace. This is why scale has become one of the most powerful forces in modern economics. In scalable systems, the heavy work happens at the beginning. Once the infrastructure exists, growth becomes easier. Revenue can increase quickly while costs grow much more slowly. Technology is the clearest example of this. A piece of software could be built once and distributed to millions of users. The cost of serving the first customer and the millionth customer is not dramatically different. Once the platform exists, expansion becomes mostly a question of distribution. But scale is not limited to technology. Manufacturing can scale when factories produce goods at lower cost per unit as volume increases. Logistics networks scale when distribution systems move products more efficiently at larger volumes. Large organizations often negotiate better supplier contracts, automate processes, and spread fixed costs across more output. And these advantages are known as economies of scale. However, scale does not appear automatically. Systems must be designed for it. Processes need to be standardized, distribution needs to reach larger markets, infrastructure must support increasing demand. Without these elements, growth can actually create inefficiency. That's how organizations can become too big for their own good. Coordination becomes harder, bureaucracy increases, and the very size that once created efficiency begins to slow everything down. But when scale works, something interesting happens. A system stops behaving like a job and starts behaving like a machine. The initial effort that built the system continues producing value long after the work is done. And when scale combines with other concepts that we've talked about, equity, leverage, compounding, and cash flow, well, the picture becomes much clearer. Equity determines who owns the system. Leverage multiplies how much influence each action has. Compounding allows results to accelerate over time. And cash flow turns the system into something that can sustain you. Scale is what allows the entire structure to grow beyond the limits of individual effort. It's the moment when a small idea, a small team, or a single product becomes something that